All right. Thank you, Henrik. Welcome, everyone. The first panel of Climate Week, so I'm sure first of many panels for everybody here today. So hopefully we could set a high bar to kick it off with our group here today. I'm excited about it. Accessible and transparent markets are essential for accelerating the global energy transition. That's the theme of the panel today. That's essentially our mission statement at Xpansiv. That's what we work on every day. Russell Karras, I run the commodities team here at Xpansiv. That involves managing our exchange, CBL markets, but also Xpansiv Connect, which is our meta registry and portfolio management system. So I wear a lot of different hats at Xpansiv, and seem like we're always kind of adding new hats to that. So we're very diverse product set, as Henrik mentioned, very diverse in terms of our global reach. But more and more so in the last 6 to 12 months, my time has been focused on infrastructure. Part of that has to do with us opening Xpansiv Connect, but it's really been a privilege seeing how different platforms and ETRMs and insurance providers and how this space is evolving. And also the talented people with outstanding experience really in traditional financial fintech sectors and different financial segments and the commodity world, how they're diving in and using that experience to help drive the energy transition. And that's really the common thread for our panel today. I'm gonna give a quick intro of our panelists, let everyone kind of discuss their experience, what they're doing to help drive the energy transition. We're gonna open it up then to a few group discussion points, and then the last 10 or 15 minutes, we'll have questions from the audience. So I'm gonna start with Sunil. Sunil Biswas is the Chief Product Officer at ION Commodities. Anyone that's traded commodities is familiar with ION and their variety of different ETRM systems that they provide. So he provides comprehensive trading, risk management, and advanced decision support solutions for commodity management. Sunil has over 25 years of experience within technology firms and global banks, leading transformational trading systems initiatives to drive business development. Joined ION in 2017 from Bloomberg, where he was head of trading solutions prior for 6 years. Prior to that, he was with Morgan Stanley and JP Morgan. So again, rich background in traditional financial markets and systems. We have to his left, Marta Krupinska. So Marta is a serial entrepreneur and seasoned executive with 15 years of leadership experience in socially impactful ventures. Marta co-founded 2 exited fintech startups, Asimo and FreeUp, and was the head of Google for Startups UK and co-lead of Google's Black Founders Fund. Alongside building Curate, Marta also chairs Youth Business International, which is a global charity founded by Prince Charles, now King Charles, and it's working to help young people start their own businesses around the world. Chris Slater is our final panelist today. He's a seasoned entrepreneur with 20+ years of experience scaling businesses with profit and purpose. As founder and CEO of ACA, the carbon insurance company, Chris is bringing this experience to global markets, global carbon markets, which is very on theme with our panel. Before joining ACA, he spent 15 years as co-founder and CEO of Simply Business, which was the world's first online quote and buy platform for small business insurance, which was sold to the Travelers Group in 2017. So to jump in, I'd like to start with Sunil from ION Commodities. Sunil, it'd be helpful to share a little bit about the products that you offer today, your experience in these different markets across your 25 years, and what are the lessons learned during those development phases for mature markets today that can be retrofitted to environmental markets, in particular, any markets that have a similar path as renewable energy or carbon?
Good, thanks, Russ. Happy to be here. Thank you for the opportunity. My background actually is in sales and trading, risk management front to back systems, been doing that for over 25 years now. Currently I'm at ION. We build commodity trading and risk management solutions. We span power, gas, renewables, crude and refined products, agriculture, consumer product goods, metals and mining, and we do the full supply chain front to back. pretty broad franchise. We have a variety of different customer types. And, with energy transition and the push towards cap and trade schemes, some years back, I think 5, 6, 7 years back, we started putting in what is now today called sort of like the instruments of the compliance markets into our commodity trading and risk management solutions. What's interesting is about 3 years ago, the voluntary markets really took off, and we needed to expand our product portfolio to go into that space. And whilst we have products that you may know, like OpenLink, Triple Point, Allegro, Aspect, and Right Angle, which are our core sales and trading and risk management tools, we created a dedicated product called Carbon Zero. And it was really around the need in these voluntary markets. And what we saw is a lot of interest and appetite from firms in the financial sector who wanted to take exposure to commodities, but weren't actually in the physical delivery of, and management of commodities themselves. So that's sort of like a little bit of a background as to sort of like what we do in terms of products. The parallels from the past are really interesting here. I've worked in FX, credit, and rates, and equity markets as well. Flow products and exotic products. And you start to look at what we have here in the carbon world. And really it bifurcates into two. In the compliance markets, you have what you traditionally need to build strong, well-disciplined markets. Think EU ETS, high degree of standardization. So with standards, you can start to build systems, and with systems, you can start to put control and discipline in place. That allows us, and I talked a little bit about our products, why some years ago we were able to put capabilities directly into our trading systems that a lot of firms use. You look over in the voluntary markets, regulations vary in every jurisdiction. The rules are different. You don't have the fungibility across markets. And so in that nascent area, I don't know, maybe credit springs to mind as sort of like an area, structured credit from 10, 15 years back. To me, that's what the voluntary markets look like right now. And that's a marketplace that went from unstructured to structured, courtesy of global financial crisis in sort of like 10 years. And maybe we don't need that type of catalyst in the voluntary markets, but as standards start to come in, I think we'll move to a much better place.
Yeah, no, and we'll definitely come back to that, because I think we've actually had that catalyst as well over the last few years that is going to end up having a stronger, more developed market on the other side. Chris, I'm going to move to you. Insurance, a lot of us in the environmental markets have learned a little bit about insurance over the past 3 years. We've learned a lot about insurance over the past 6 to 12 months as it's become required for certain compliance programs. So it's very complex, it's regulated. Again, I'm still personally trying to wrap my head around everything. What was the process that you've had in the past in those regulated insurance markets, moving those onto a platform and to using more digital technology for the first time? And obviously, great to hear how you think that could apply in the energy transition.
Yeah, thanks, Russell, and definitely touching on a couple of points I think you've mentioned there around sort of unstructured data. Maybe just to take a step back in terms of where insurance has played a role. For 300 years, we've all got personal relationships, probably with our own insurance providers on sort of home and auto, good and mainly maybe bad. But insurance has been a foundation for new markets. It's been, if we think about sending satellites into space, if we think about manufacturing, if we think about hosting events like this, insurance is sort of the underpinning of an ability for businesses to thrive. And therefore, what I did in my previous business at Simply Business was really look at how can insurance play a role for small businesses and really get out of their way to allow them to run their business. So what we did is we looked at a whole host of unstructured data that existed in the market and then digitize the experience for millions of small commercial enterprises here in the US, in the UK, allowing them to basically come on, buy insurance in a standardized, commoditized, and efficient manner to drive costs out of the industry. You know, insurance is heavily regulated, also means that over those 300 years, lots of intermediaries have ended up playing a role in high costs. So I always look at how can I make things simpler and how can I make things efficient so that insurance can be transacted and enable that glue, enable that sort of liquidity of allowing people to take risk. So how does that translate to the carbon markets? Well, a couple of years ago, I looked at the voluntary market and everyone was talking about risk, but there was no insurance that existed whatsoever. So how does it translate? Well, here in the carbon market, I think insurance can play a fundamental role of building trust and building transparency. It's required in terms of being able to price the risk, to look at the levels of unstructured data that exists around a project, to understand where those risks sit, to put them in buckets of market risk, pricing risk, jurisdictional risk, of operational risk. There's a whole host of these buckets, but by using that data, allow ourselves to price that risk and enable that risk ultimately to be taken off the table between various parties, whether that's for developers who are looking to access new markets, be Corsia, or purely trying to sign contracts with an off-taker or buyer. Quite often the contractual and risk elements that sit into those contracts, we as the insurance industry can take that risk off the table and use our balance sheet to price and basically pay off that risk. Equally for developers in terms of trying to access capital. How do we fund the very best projects to continue to scale? Insurance can play a fundamental role in terms of a balance sheet separate to finance to again allow developers to be able to scale. So I think in a view of where the insurance market can play a role moving forward, I really see ourselves as a catalyst, really sort of tip of the spear to bring insurance balance sheets in the billions of dollars into this market to help risk get taken off the table for many of you in the room and help developers effectively do what they need to do.
Great, thank you. Now, definitely going to come back to data as well as we start the group conversation. But first, Marta, again, kind of a different take, different experience. You know, looking at your work with Google and several successful fintech companies, what lessons are you applying to Curate, and just more broadly speaking, what could be applied to the market?
Very, very useful, thank you. And it's so interesting because I was just listening to the other speakers and sort of thinking how basically what I do and what we do at Curate is very much upstream to where you guys are, because I represent the carbon removals market, and different people have different taxonomies, but my perception would be that today we basically have 3 carbon markets. We've got the compliance market, the ETS, we've got the traditional VCM, so the offsets, the protection and the reduction credits, and carbon removal is a completely new asset class, will be $1 trillion industry driven by compliance, but right now it's entirely voluntary. It's terribly confusing. It's so interesting. You're talking about systems and standards. There are very few, and it's unbelievably difficult to navigate this industry. To buy insurance, you first need to know what you want to buy. So in effect, what we do is we work with organizations that understand that in line with SBTi and basically all other standards, there is no net zero without carbon removal. You have to radically decarbonize and then buy removals for your residual emissions. But if we don't start investing in this market today, in 10 years' time, when people start hitting their net zero goals, there is going to be no carbon removal, or it's going to be completely prohibitively expensive. So we work with the likes of, actually, we just announced a deal today with British Airways that bought $11 million worth of carbon removal credits. And the goal is basically we're a science, procurement, and management platform for corporates to come in and start building out their own expertise, really, with regards to an asset class they're going to have to heavily invest in over the years to meet their future regulatory obligations. So I suppose sort of what brought me to this market, I started in fintech. I just cannot speak to the number of parallels between what I'm finding in the environmental markets and in fintech. At the end of the day, it's all about building trust. And I think that's what we all here on this stage are, and what everybody in this room is interested in. It's about trust and risk, and being able to balance those in such a way that we can pour more capital into the market and direct it in the right places. But also, when I draw from my experience at Google, a big part of my job at Google was investing Google's resources in building new markets and building new companies that are using innovation to, alongside making money, also having big impacts. And what I loved about the fact that in carbon removal, we're basically building a $1 trillion industry in which a lot of these companies are going to fantastically lend themselves to the global south. We're talking about a massive challenge that we have from an economic perspective, but also from a social perspective. How do we de-risk the global south that is most exposed to climate change? So we're basically building an industry that is not only helping fit and sort of satisfy the future regulatory requirements for global corporates, we're also channeling capital to the right places, not through aid, but actually through commerce. And I found that one of the most compelling and interesting ways in which any of us could really get involved today. And I'm hoping that through the work of all of us on that stage, and obviously you guys at Xpansiv, we basically need to build, we call carbon removals the space race of the 21st century. We need to build this industry faster than never before. So all of us need to start working together much faster than normally we would probably allow 10, 15 years for the market to normalize, for standards to emerge. And right now we're trying to build the plane as we fly it.
No, 100%. And we have to show that capital that's coming in from market-based mechanisms like carbon credits is funneling its way down to the project developers and fulfilling the role of sustainable finance, carbon finance. That's an important key theme, again, not just for carbon, but for renewable energy credits. Brian Fellon's going to talk a little about plastic credits too, and speaking to some of the manufacturers now. That's their biggest concern. They say, show me the money flow so we can use the credits. So Chris touched on data a little bit. Sunil, maybe we'll start with you in this, the next topic. So environmental credit markets are inherently digital. What's the role for data in carbon and renewable markets? How advanced, from where you sit, are we in really synthesizing, distributing that data in an effective way? Like, where are the key areas that you think we need to improve?
It's a great question. I mean, we live in exciting times. So I think I mentioned before, if you look at parallels in other markets, FX, not a lot of data, fixed income, more data, obfuscated, a lot of calculations, equities, tons of data, credit, even more. Carbon, potentially even more, right? We're modeling physical assets here. If we were doing this 10, 15 years ago, we're saving data onto our C drive. Today, we're in the cloud. We have AI-enabled technology. So actually, our ability to mine and operate on data is a lot more sophisticated these days. And so for those inclined, you can access the data, you can process the data, you can apply your hypothesis and look for patterns a lot easier. Again, the market, in my mind, bifurcates, possibly trifurcates between those areas where data is certainly structured. And then again, this is really coming from the compliance markets. You can look at pricing of assets. It's much more deterministic. You can start to see trading. We move to exchange-type models, not quite central limit order book, but you can see how you move there very quickly with regulation. And that digitization curve to move electronic into a marketplace, it's well understood. It's just a matter of how quickly you move there. I think on the compliance side of things, just building on that trust, I think someone famous once said, trust but verify. So to verify, you need to go out and get a whole bunch of data. So you've got all these projects all over the world. I mean, are they for real? We believe so, but we have to verify. So there's a whole bunch of unstructured data gathering there. And as I said, in years past, it would have taken a lot of processing power to crunch through that data and look for patterns and signs and anomalies in that data. Today, we have the ability to process that a lot faster, and I think that's an area for those inclined that I think is an industry we can move forward very quickly on.
Can I come in there? Because I think, just to build on that, I guess, thinking about the 2-year journey that we've been on to try and price some of that physical risk or look to projects and try and understand what data can we gather around that specific project to give us the verification of the project, to give us aspects of the climate risk. I've got to model, okay, how do I expect that project to develop over the next 5 to 10 years? And how do I forecast potential severity or frequency of events around those projects? I think what the industry lacks at the moment is an element of standardization in some of access to that data. A lot of that data is locked in buckets around whether that's on the rating side or whether that's on the verification side, whether that's on the registration side. I think an ability to get access to that data is going to be crucial from an insurance industry standpoint to then be able to apply its weight of understanding around those standards. So I'm encouraged by the technology that we've got now on our hands than what we had 20 years ago. We're using machine learning to sort of look at some of that data and then model out scenarios on how the frequency and severity of a particular event might take place. But getting access to that data is key. So really for me, it's around how do we foster amongst ourselves on the stage with yourselves Xpansiv, how do we foster a way of being able to get access to data in a much more efficient and effective manner to be able to price the risk?
Yeah. And Sunil, so you have sophisticated, users, Sunil, traders that are used to lots of data, and you have obviously like actuaries working with large sets of data. Marta, you have end user corporates who would have to navigate removals, avoidance, ratings, CCPs, compliance programs, a whole host of different issues. And from working on an exchange as well, trying to figure out like how much information can you put in a screen for a buyer to use? Like how do you best get all of this data that we have into a digestible format for users that aren't living in this world every day?
Well, that's $1 billion question. And I think if you know the answer, I'll try and poach you from Xpansiv and ask you to come to Curate. And no, seriously, I think, there's actually, and again, building on the conversation that we've just had, I think the challenge is, and especially so we focus on carbon removal, and there is a lot of data. What we don't have is delivery data. 94% of the market is in the future. These are corporates that are signing up to carbon removal, carbon sequestration happening in the future. So they're basically buying a future of an unregulated asset in good faith that the credits are going to get delivered, which is part of the reason why, Chris and team at Oka are doing God's work, because a lot of these transactions would not be taking place without insurance. And ultimately, the role of insurance here is we gather all of the data that we can get. We make hypotheses with regards to what we believe is the right price for the right risk. But again, largely, these are now hypotheses. And then depending on different types of clients, there are those that don't want to make a claim. So they're probably more ready to take on some of the risk, because in the case of under-delivery, there isn't a risk to them being able to make that environmental claim. On the flip side, there are those that are now already committing to long-term carbon removal offtakes that are aligned with their net zero date. And in the case that there is an under-delivery, they wouldn't be able to make a claim. So then insurance is really, really key. I suppose in relation to how much data to show, I would say, again, this is my 4th company. I have never found building a digital product as hard as we do at Curate. And my product team is so unbelievably frustrated because we cannot find potential clients to do user testing with. We're sitting down with sustainability managers, with finance teams, and we're saying to them, so what kinds of problems are you facing when you're trying to manage your future liability with regards to carbon removal? And they go, what carbon removal, what is that? What tools are you currently using? Well, we don't really. Where do you keep it? Oh, maybe in a spreadsheet if we even do it. So we're really in a nascent place in the industry. And I think, largely, probably, I see my business evolving hugely over the next 10 years. We're now a team of human scientists operating a piece of software that largely we operate, because the people that we sell to find it incredibly hard to enter the market, understand the price, understand the risk, understand which data points to look at. Not to mention that, again, carbon removal, avoidance, reduction, regos, all of those are governed by slightly different regulations, slightly different outcomes, slightly different incentives. So in effect, a lot of what we do today is an enterprise sales service on top of the software that we've built. I think as the market moves and more sophisticated buyers come online and there's more appreciation for what's important and what isn't, and just more data literacy amongst teams that we're selling to, both sustainability teams and finance teams, this is going to start changing. I suppose the only exception might be when we speak to our banking partners in traders, commodity securities. Again, I would say we're at the infancy of the industry. One of the deals we've done is we work with Standard Chartered Bank. So we unlocked working capital for a carbon removal supplier off the back of a long-term offtake that we did. A lot of the challenges in carbon removal is related to the fact that project finance isn't really available because banks don't know how to price the risk. But then buyers don't want to pay up front for something that's going to happen in the future. And then suppliers, often small companies, ran on VC money, don't know where to get capital from to do the thing that sequesters the carbon so they can deliver the credit so that the corporate pays for the credit. So we've definitely found it easier to work with financial institutions, and those are very, very hungry for any data we can give them.
Sure.
I'd just like to jump in at a parallel here. So I don't want to scare anyone, but cast your mind back sort of like 10 years ago, illiquid assets, no one really knew how to price homes down in Florida. We had subprime blow up. Why? Because we were all looking at what rating agencies were saying about some underlying asset that was difficult to price because it's inherently an illiquid risk, right? Mm-hmm. So we need to be very careful with data. So there's data that we will see in the form of benchmarks, and the industry can go off and build derived products that trade off of benchmarks. But ultimately, you've got to look down into the details of all the projects, and I mean, you'll see it as an upstream player, right? Whether a forest is different from carbon removal from the atmosphere through technology and what have you, and everything gets priced differently. And I think learning from the past, we as an industry owe it to ourselves to look at that first principles data every time, rather than just trading off of benchmarks and ratings that we might just happen to see out there that the industry produces.
But I suppose if I can just very quickly comment on this, I think it goes back to what you talked about, which is standards and systems. So for instance, again, just zooming in on carbon removal, CDRFYI, which is the main platform we look at for data that sort of reports on the actors in the space. There's about 400 suppliers. We've looked at all of them. We've only bought from 3% of them. And I have a whole team of people that are basically looking at these projects day in, day out. Yep. So we're sort of, I think it's sort of very much starting from quality over quantity. Then that poses the challenge, because then, basically you're building a deep data product rather than a broad. And then if you're trying to build an industry, that obviously has its pros and cons. But I think you're exactly right. I think exactly building on what we've learned from the past, and also with some of the environmental assets not always being as true to what they intended to achieve. I think we have to walk before we run.
Yeah. And where you have the illiquid risk, what you do in your personal life, you buy insurance.
Thanks.
Yeah.
There's a song. Give it over here.
There's a song.
Yeah. Can I just touch on, Marta, you touched on that sort of co-creation. I think both of us coming from e-commerce backgrounds where almost like co-creation and building a product or building a solution to a problem that collectively you're working towards. Again, whilst that's where, we built a product with a developer aimed at the Corsia market. And what was so powerful about that was actually being able to get to the root cause of the data that we were looking for to price the risk. But importantly, actually solving the problem that the developer was looking for. I think from a collaborative standpoint, again, as an industry, we're still looking to leverage tools that have been well established in terms of ways of working, and certainly from a product perspective, building solutions to problems that people want solving. Financial institutions are leaning into that and starting to lean into that now. I know the work that we're doing with yourselves at Xpansiv, we're starting to lean into that. Only if we work together to really look at the root cause of that data can we then pop out with a solution that makes sense. Mm-hmm. Otherwise, it's just throwing a lot of stuff at the wall, and it's not gonna stick.
So no, appreciate the insight there, and we think we're coming back to the credit market. We're talking about ratings and insurance and removals. What role do we think that the interplay between compliance and voluntary markets are going to play going forward. Obviously, we're hopeful that in November, ICAO approves additional registries for CORSIA. If we think about standardized products and benchmarks, we haven't launched one really in a few years because we've been waiting for that compliance phase of CORSIA to start because you have that natural demand, kind of what you need to drive a commodities market. How important is that, I guess, for each of you in terms of moving forward, that interplay of compliance and voluntary?
Yeah, I mean, I'm happy to take the lead on that, having literally, as I said, spent the last 6 months building a very specific product to solve a double counting risk issue that ICAO have asked the standards bodies to deal with in their resubmissions. Like for a developer, how are you going to ensure that a corresponding, and technical here, but a corresponding adjustment is going to be made on the credits and the contract that you formed with a host government? So effectively, our product makes it look like the corresponding adjustment has been made. If the host country doesn't file that within their biannual BTR report, then our policy pays out. So we've taken a bet that the compliance market, and specifically CORSIA, is going to continue to drive standards within the voluntary market. I think our view is that from a governance standpoint, which I think is the crucial point underpinning here, as a governance point, that sort of regulation and that sort of forced behavior, there's a risk that exists here. How are you as an industry, the VCM, going to deal with this? Forcing the industry effectively to raise their game to manage that risk is going to be key. And therefore, that's for us where insurance can more clearly play a role. There's a penalty. If the penalty happens, there's a claim to be made, we can pay out on the claim. So our views at OCA is that the compliance and voluntary markets will converge over time. I think you'll, as you're starting to see within Singapore, South Africa, Colombia, Mexico, these markets are starting to go, okay, from a tax perspective, you could go to the VCM and buy credits, but they're going to have to be high quality. They're going to have to meet specific standards. And for those standards, we see a sort of what I would hope to see is an alignment around what those standards look like.
Yeah, and it's not just that these standards have been in place, but they're also tightening by design.
Yep.
Right? These are this is the voluntary market. We had that hockey stick effect. Now we're kind of incrementally progressing, which is probably the right way to do it, which is how compliance markets are designed. So South Africa went from 850 last year to around 1050 this year, and they're projected to go. It's designed to go above $20 in the next few years. Speaking to a lot of firms in Japan in 2026, 2028, they're going to hit certain milestones where they're going to tighten. I think that's why we're seeing this infrastructure boom across environmental commodities, because people within those countries and regions see that it's going to be mandatory, in addition to things like disclosure requirements as well, having to report on your climate commitments. Marta, what do you think? Do you think that if I'm buying a voluntary credit on the Curate platform, do I care that it has an LOA? Do I care that it's CORSIA compliant or it could qualify for the Singapore tax?
I mean, I think absolutely. Well, I don't think we're going to. So again, sort of the scientists will tell us we need 10 gigatons of carbon removal each year by 2050. I don't think the voluntary action is going to take us there. The deal I just mentioned, $11 million by British Airways, that makes them the 15th largest buyer in history of carbon removal. That is terrifying because, in the grand scheme of things, is definitely insufficient. And definitely, so for instance, CORSIA, we're huge fans of CORSIA. I desperately wait for CORSIA to want to include carbon removal in their scheme. I think we're going to need to create incentives that go way beyond voluntary action, because that's where real budgets come from. And that's also what's going to drive value, drive quality. So this is when the market really becomes liquid and well-performing. The only thing I would add is, and this is something I'm slightly nervous about, and I'm not sure how it's going to evolve. Again, from my part of the world, which is carbon removal, we're sort of celebrating the compliance markets, hitting $20, in some other parts of the market, $80 or $100. The price of carbon removal right now, depending on the pathway, is sort of between $50 and $1,500. So I wonder, as the markets converge, what will that mean for technologies that are just inherently much more expensive? And we're going to see prices going down, but I know that, for instance, in the UK right now, where we're based, the Department for Energy Security and Net Zero is talking about including carbon removal in the ETS. But then if the ETS is trading below £100, then most carbon removal suppliers wouldn't sell anyway. Then what does that mean? So I suppose there are still certain answers that we need to find, but I think we're very excited for the direction of compliance, and also very grateful to all of the organizations that are acting as rule setters. In the meantime, I know you've got ICVCM, VCMI represented today. So.
No, and the CFTC report on Friday as well. Still reading through the 100 pages, but largely supportive of ICVCM and Corsia and the legislation out of California. So I wanted to open it up. We have about 10 minutes left to any questions from the audience. We have one right here.
Hi, I'm Reed. I'm with a project developer called Native, we're Public Benefit Corporation. I guess I have a question around the onus of insurance and who should be taking responsibility for it, given that buyers are typically price and budget constrained and not willing to shell out more than they absolutely have to, and generally being risk averse anyway, versus a lot of project developers, as you mentioned, are smaller organizations who are looking for financing either through offtake or through financial markets and financial institutions who, depending on the type of policy or the type of risk, might not be in a position to take out a policy that would cover the perceived or the inherent risks. So, how do you see that changing?
I think that's probably a question for me, isn't it?
Repeating the question from the stage?
Yeah, happy to. I think the question was around who's going to pay for the insurance, basically, especially in a price-sensitive market. If we look at the developers, the margins are thin, especially as they look to try and build forward contracts and try and scale their projects. The economics are challenging there, and then on the buyer side, I think the question also was: is the buyer willing to effectively pay for the insurance again?
How can you make it catalytic as opposed to a hurdle?
Yeah. So I think we're trying to figure it out. I think I sort of call it out first. As you map the life cycle of a credit from project inception all the way through to ultimately issuance and post-issuance, there's a host of risks that exist for me across the life cycle of that project. And then you've got to get sort of project specific. So if you're looking at a clean cooking project in Madagascar, what are the risks that exist around that project related to that developer accessing Corsia is going to be very different from the funding of a reforestation project or a carbon removal project that isn't going to be issuing credits for 8 to 10 years. So I think that context is important because I think the risks sit in very different places within those transactions, and therefore who bears the risk is going to vary, I think, by virtue of the type of project, the location of the project, and ultimately the stage of that project. I was speaking to a developer last week, specifically related to Corsia. They're a project that is just seeking an LOA at the moment. They're looking to hopefully list their credits via Vera, Corsia Article 6 compliant and Corsia compliant. And the challenge that they were saying to us were, our economics don't work in terms of if we have to bear that risk and pay for the insurance for the credits, it's going to be incredibly challenging for us and how do we know what the price of credits is going to look like over the next 2 to 3 years? My challenge back to them was that ultimately from an insurance standpoint, where does the insurable interest sit? Like who bears the risk? That developer bears the risks. They've signed the contract with the host country. It's their work over the last 2 years in that country to stand their project up to start to issue credits. And therefore, if something happens, it's ultimately their issue and it's their issue to remedy. Take insurance out for the moment, it's still their issue to remedy whether insurance exists or not. So they're bearing the risk in that example. What I said to them was, insurance, you will buy I think you'll end up taking the insurance out, but I think in a mature market, what you will start to see is insurance just embedded into the life cycle of the credit. And ultimately, in a scale market that's liquid, with prices that are not constrained as to where they are today, then ultimately the insurance premium sort of flows between contracts, between developer to agent to intermediary to ultimately to buyer. Philosophically, for me, the buyer should end up paying, from a pollution standpoint, and they're the ones that ultimately should bear the cost. I think the challenges we've got as an industry at the moment is we're just at the formation, and how does it work today versus how does it work tomorrow? There's a journey for us to go on. So I hope that was sort of helpful in terms of giving an illustration of where the insurance can sit. Specifically, Marta can talk to the deal they did with BA recently and Standard Chartered from a financing standpoint. I imagine it's the bank that's taking the policy out there.
Yeah, I suppose there is, especially for those parts of the environmental markets that are completely nascent, there are certain risks that financial institutions would normally bear because they could price that risk because there is enough data. Again, in a world where there is not enough delivery data, insurance could mean that price of capital becomes much cheaper. And I suppose what we did in our partnership with Standard Chartered, the hope was to basically reduce the cost of capital. So we're trying to get to a flywheel effect where we can offer carbon removal credits to buyers at a lower cost because suppliers don't have to price in the cost of capital into their cost of credit. So we can say to buyers, buy credits, don't pay upfront, get an offtake that gives you today's price in the future, no upfront payment, the money still flows to the supplier, is provided by a bank, and the bank is able to issue debt because the risk for them is palatable, because you can play an insurance. And I suppose long term, it might be that there won't be in this particular kind of a transaction, there won't be need for insurance because again, there'll be enough data. But today it is truly catalytic.
Yeah.
And Sunil, if you're an oil trader, you're shipping, insurance is part of your everyday life. Do your systems account for that? Is this something?
Absolutely. Insurance is very much part of the trade financing side of commodity trades. Less standard the trade, the more the insurance gets embedded into a larger structured deal. In some ways, I'm a very simple person. Buyer always pays. So if you're originating and you, as an issuer, so to speak, and you actually want someone to acquire that asset, you're going to pay for the insurance. If you can't do it, your bank will pay for it. Who pays for it doesn't really matter because the cost is ultimately going to be passed on to the buyer, right? And again, these are the type of things you see in market evolution. So something may start in a certain area, but ultimately it will move to a much more streamlined process. And you see it everywhere else. Every bond is essentially insured, by a ratings agency, right? In many people's minds, right? Except for government issued, and which they back. As this industry evolves, that's what you'll see, and ultimately the buyer will pay that premium, and that's what will be recovered.
Great. Thank you all for that. Do we have any other questions as we have a few minutes left?
Great panel, folks. Thank you very much. Mark McDivitt, Context Labs. Data has been a big central theme of the conversation this morning. I think it's really a question for all three of you. How are you enabling the trust in the data that you're looking at? All sorts of disparate data noted, but how do you trust that data?
Well, I can go first. Right, we're going to get our data from Xpansiv. So Xpansiv to pull from the registries, and we're going to deliver it to our customers. But I do think it's the ultimate source of data, and so anything that is industry regulated or even consortium governed by thought leaders in the industry really matters to us, right? And again, I think in this industry, it's nascent. It's very early days, and we're fortunate enough now to have AI-enabled technology that can find those anomalies very quickly.
Anybody else want to?
I suppose my answer won't be very different. It's interesting you mentioned AI. Obviously it's 2024, right? I think it's something that we somewhat struggle with. We have primary data from suppliers. We have third-party data from verifiers that we work with. We use proxies for data that we're receiving. We have human scientists reviewing the data we're receiving. And then we have an AI-powered software platform. And we're basically trying to triage all of it all together. Right now, there is an element of strong opinions loosely held. This is the best that we can do. And then we're waiting for deliveries, for delivery data to verify that what we believe to be true has actually happened, and there were credits issued. But I suppose that goes to the very heart of, in effect, well, in my industry, delivery risk, or the reasons why there is need for Chris's product. Well, I suppose right now, the best that we can do is take what all of the, what basically this industry has been doing for the last 50 years and try and, again, following the same pathway, sort of what are the standards, the systems. I suppose I'm very hopeful, but I wouldn't be sitting here if I wasn't. But it's definitely a challenge. And the more that we appreciate the challenge, the more that we can direct resources there to anticipate it.
So we're just out of time. I don't know, Chris, do you have any final thoughts?
I'll just close out with, I guess, we operate in the imperfection of data. If the data was perfect, insurance wouldn't be required. So from us, it's about overlaying all those different sources of data. But there's a misconception, I think, as I've come into the market, the carbon markets, that you can manage away with data risk. And that's just, there are unforeseen and unforeseeable events that you cannot manage away. So, collectively and collaboratively, we look towards bringing better data standards, improving that data, and with risk will still exist. So that's that combination, I think, of the work that we can do together to take some level.
Great. Well, that's our time. Appreciate the panelists joining today. Very insightful conversation. And if anyone has any other questions, hopefully we'll be able to hang around and answer them throughout the day. Thank you.
Thank you.
Thank you.
Thank you, everyone.
We have 15 minutes in between the next session. So the next one starts at 10:30. If you have any questions for the panelists, you guys can ask them now, grab a water or anything.